Why does a casino, an institution with a guaranteed, mathematically proven edge, have a maximum bet limit at the blackjack table? Why won't they let a wealthy gambler walk in and wager $50 million on a single hand of cards? It is not because the casino is afraid of losing $50 million in a single night. They have massive cash reserves. They refuse the bet because they understand the law of large numbers. Their mathematical edge only works if it is distributed over thousands of small, independent events. A single, massive bet bypasses their edge and introduces absolute variance. It turns a business of predictable probability into a game of pure, uncontrolled luck. Most traders believe they understand risk management. They have read the books, and they know the golden rule: never risk more than 1 or 2% of your account on a single trade. But then, a real trading week begins. You suffer 3 losing trades in a row. You are down 6% of your total account value. The math made perfect sense on paper. But in reality, those consecutive losses feel like personal insults. Your heart rate rises, your palms sweat, and your logical brain begins to slip away. Frustrated and desperate to get your money back, you double your position size on the next trade. You tell yourself you just need one good win to erase the damage. Instead, the trade fails. In a matter of minutes, weeks of disciplined work are completely wiped out. To manage risk properly, you must first understand why your brain is biologically wired to sabotage you. In the 1970s, cognitive psychologists Daniel Kahneman and Amos Tversky discovered a phenomenon called prospect theory. They proved that human beings do not experience financial gains and losses equally. The psychological pain of a loss is twice as powerful as the pleasure of an equivalent gain. This asymmetry causes a strange behavioral shift. When we are winning, we become risk-averse, we cut our profits early to secure the gain. But when we are losing, we become highly risk-seeking. To avoid the pain of realizing a loss, we will widen our stop losses, add to losing positions, and take massive, irrational risks, hoping the market will bail us out. But the mathematics of recovery are brutal and unforgiving. The math of drawdown is not linear, it is exponential. If you lose 10% of your account, you need an 11% gain just to get back to where you started. This feels manageable. But if you suffer a 30% drawdown, you now need a 43% gain just to break even. The hill has become much steeper. And if you lose 50% of your capital, you must double your money, achieving a 100% return, just to get back to zero. At this point, survival is statistically improbable. Professional risk managers do not view the market as a place to make money. They view it as a place where they must buy insurance for their survival. Consider how an insurance company operates. They do not know which specific car will crash today. If they tried to predict individual accidents, they would go bankrupt. Instead, they rely on actuarial science. They collect small premiums from millions of people, knowing that the aggregate math guarantees their survival over thousands of claims. To manage risk like a professional, you must stop thinking of yourself as a speculator and start thinking of yourself as an insurance underwriter. To do this, we use a 3-tier system called the survival engine. The first gear is the transition to the R-multiple mindset. You must stop thinking of your risk in terms of dollars, euros, or percentages. Instead, think of your risk as a fixed unit called R. If your maximum risk per trade is $100, that is 1 R. Your target should always be a multiple of that risk, ideally 2 R, or 3 R. By thinking in R multiples, you realize that you can lose 60% of your trades and still make a highly profitable return, because your average win is 3 times larger than your average loss. The second gear is the drawdown buffer. Most traders use a flat position sizing rule, risking 2% on every single trade regardless of their current performance. A professional uses a dynamic risk model. When you are winning, you risk your standard size. But when you enter a drawdown, you systematically scale down your risk. If you lose 3 trades in a row, you automatically cut your risk in half. If you lose another 3, you cut it in half again. This preserves both your financial capital and your emotional sanity during tough market conditions. The third gear is the operational circuit breaker. Just like an electrical system has a fuse that blows to prevent a fire, your trading account must have a hard shut-off point. Determine your maximum monthly drawdown limit. If your account loses 10% in a single calendar month, your trading for that month is over. You unplug your computer, step away, and analyze your performance. Before we finish, please remember that trading is highly speculative and carries a substantial risk of financial loss. This content is for educational purposes only and does not constitute financial advice. The vast majority of retail traders lose money. In the end, proper risk management is not about being right on the next trade. It is about structuring your business so that no single event, nor any single streak of bad luck, can ever take you out of the game. Protect your capital first, and the profits will take care of themselves. We'll see you in the next session.